For those of you who have signed on early, we're waiting a few minutes for people to show up. I'll just speak a little bit and then hand it over to Bryan and introduce ourselves. I'm with Cap Management. So we do sustainability work with HOAs. And for us, it all starts with fiscal sustainability, because without fiscal sustainability, you can't do anything else. The other thing we like to do is water conservation. Back to fiscal sustainability, 1/3 of your HOA dues, or a quarter, is water consumption. So by simple fixes to your sprinkler, we can reduce your water consumption 30%. We're being water conservation sustainable and fiscally sustainable. We also do composting and recycling because that's what we find that the homeowners in our HOAs want. We've done solar roofs and electrical vehicle charging stations. We haven't done the solar panels by Elon Musk yet. We're looking for an HOA that wants to do it. But we redo roofs because Colorado is such a high hail zone. We make sure we put like a Malarkey Class 4 product, which is each roof has 5 tires recycled into it and then about 20 milk jugs. And it is Class 4 sustainable. So it is hail resistant. Nothing is hail. And finally, efficient building systems. And for us, that means, you have a building where at the 10 stories tall, at the ground floor, all the air wants to go up and out. So you have a makeup air handler unit pushing the air back down. And then on each floor, it used to be $2,500 a floor. Now it's $250 a floor. You put a balancer to adjust the pressure. And that means in the winter, your heat isn't going out of the building. In the summer, your air conditioning isn't going out. So we do manage 50 HOAs with 6,000 homeowners in the metro area. We are very focused on sustainability and resiliency, because if you take care of these problems up front, they'll become more expensive down the line. I'll let Bryan talk a little bit about what that means in terms of being resilient financially. Bryan?
Yeah, thank you so much, Chris. So that's exactly what we'll be talking about today during my presentation. Once we get there, we're going to be really discussing on what really matters to me is making sure that every owner at a property, regardless of how long they live there, when they move, etc., everyone's paying their fair share. We want to make living at an HOA sustainable. We want to make sure that no owner feels like they're being taken advantage of. We want it to be as fair as possible, because really living in a homeowners association is a very valuable way to preserve capital when you purchase a home. It's a great way to make sure that your value of your property, which is typically one of the larger investments that, or larger purchases that an owner will make, an individual will make, we want to make sure that that is sustainable. We want to make sure that it's actually as affordable as possible, because really there's a way to make that work. And so that's what I'll be discussing today during my portion. So thanks so much.
Great, thanks Chris and Bryan. We were just going a little bit of time to let everyone join the webinar, and it looks like we've got plenty of people in. It's nice to see some familiar names. Bernice, hi, how you doing? Emmett, Lester, Michelle, nice to see you all. Thanks for joining us. So we're going to go ahead and kick this off. This is Cap Management's spring webinar series on sustainable HOAs. Today our topic is on financial sustainability. Chris Crigler, owner and CEO of Cap Management, is going to start with a discussion on financial literacy for community associations, followed by Bryan Farley, reserve specialist and president of Association Reserves Colorado, who will be speaking on the importance of reserve funding and capital planning strategies. The two presentations will run about 30 minutes, followed by a question and answer session immediately after. So if a question comes to mind during either of the presentations, please use the chat box. You can find that by clicking the bubble with the question mark to submit your question, and we'll respond to them at the end. Also, under the handouts tab, you'll find a page, a one-page PDF highlighting the key takeaways from today's presentation. Before we get started, though, I just wanted to give a brief introduction to the Sustainable HOA series. My name is Chris Marion. I'm the Chief Sustainability Officer for Cap Management. And our approach to sustainability within the HOA industry is to really utilize a comprehensive strategy, considering sustainability from a financial standpoint as well as environmental and social. Some of you might be familiar with this concept as known as the triple bottom line. It's a term used in the business world when referring to companies that consider both the environmental impact of their business in terms of operations, as well as the social well-being of their employees and other stakeholders. We found the concept of the triple bottom line framework to also be an effective way of working with community associations. HOAs operate much like a not-for-profit real estate company, and the viability of the HOA community really depends heavily on how it's financially managed. Environmentally, HOAs have significant opportunities in conserving water, making energy efficiency upgrades, or providing recycling and composting to the residents. And lastly, every HOA at the end of the day is a residential community and a place that millions of people in Colorado call their home. We believe that HOAs can play an important role in encouraging meaningful resident engagement and participation while also building a sense of community. But today's presentation, we're focusing primarily on the financial sustainability pillar. In our industry, we found that a community association must be financially stable before it can effectively address environmental or community-based initiatives. So with that, I'd like to turn it over to Chris Crigler. Chris is the owner and CEO of Cap Management, which he started back in 2003. Over the past 17 years, Chris has steadily grown Cap Management's portfolio, serving clients all over the Front Range. With each HOA, Chris Crigler always encourages the board members to truly understand the financial management aspect of the industry. So Chris, please take it away. In just a moment, I'm going to pass off the presentation to you.
Thanks, Chris. So if you're a new board member or even have been on a board for a long time, you know that much of the board meeting is taken up by going to financials. And unless you've had an accounting class or a CPA, the balance sheet, the comparative balance sheet, the income statement, a aging report, takes you a while to learn what an aging report means. And nobody wants to look silly or stupid by asking questions. But if you don't feel comfortable asking questions in a board meeting, reach out to your property manager, or better yet, ask to meet with the accounting department, just to familiarize yourself with your roles as a board member. So we follow the money in HOAs. And the first report is the balance sheet, and it's the summary of all of the other pages in the financial report. So if you look at the balance sheet, what you want to look for is how much money you have in the bank. Here it's $41,000, and how much money people still owe in terms of dues, $1,262. Balance sheet is great. What Cap Management does is we do a comparative balance sheet, which shows the current month versus the prior month. And if you look at the first line here, you see current month they have $41,000 in the bank. Prior month they only had $15,000 in the bank. So what you want to be asking yourself is, how come and why did that change? And especially now when everybody's uncertain about HOA financials, it makes even more sense to be watching on a month-to-month basis. You can ask your management company to present this for you in a spreadsheet that you can track yourself. But once you understand the financials, then you have power over the financials. And again, now that we have coronavirus and people might not be paying their dues, pay attention to the accounts receivable. That's how much money people owe on dues, and find out if it's going up and down or why. So the balance sheet is the summary of all the other financial statements. The next one is the income statement. So I'll do a quick question. If you know everybody is paying their dues, why, or is not paying their dues, why does it show that all assessment income was collected on the very first day? If you look at the first line assessments, actual 104,774, budget 104,774, but the prior sheet, we knew there were accounts receivable. Well, this is an accounting thing. Accountants try to match income with expenses in the same period. So the answer to that question is, in accrual accounting, the very first entry is to debit the dues, credit the dues as if everybody had paid, and then debit accounts receivable. Remember I said watch the accounts receivable on the balance sheet? Then as money comes in, the dollar amount of the accounts receivable goes down and the cash amount in the bank account goes up. So that's what you want to watch on the income statement, or that's the biggest question people have is, really, are we collecting all our assessments? Because you just showed me your delinquency report. The other thing on an income statement is pay attention to the broad categories: total utilities, total grounds maintenance, and look at them on a period-to-period basis and a yearly basis. With grounds maintenance, all your expenses are going to come in the summer. So for January, February, March, you're probably going to be very much under budget. And then July, August, and September, you're going to be very much over budget. And because professionals on your board and at your management company put this together, usually at the end of the year, it should balance out. But if we have a heavy snow year with 10 storms, you're going to know in January or February that we're going to have problems. If you see a lot of money in irrigation repairs and water usage, contact us, because the best way to save money on your dues is to upgrade your irrigation system. One, fix all the leaks. Two, get a good timer in there that not only shuts off the water when it's raining, but also controls your water usage to what your grass really needs. In addition to that, every financial for an HOA is broken out to operating income, which is day-to-day, and then reserves, which is stuff that you don't do on a yearly basis. And Brian's going to go through your reserve study. He's not going to tie it back to this reserve income statement, but when you're looking at your financials on the reserve portion, then you should be able to tie that to your reserve study. And when you have questions, feel free to call Brian. In addition, you'll get an aging report, which gives the details of the people in collections. But what you want to know here is the last payment. So you can see here the first person last payment was $388 on a 4/30/19. As we go through the coronavirus and people start going back to work, that's what you're going to want to look at. Is not only how delinquent people are, but how recently they have paid. Because by law, you're required to have a collections policy and to follow that. And it's generally 30, 60, 90 days to collections, but you can make an exception. If you know one of your neighbors had a death in the family, yeah, then you can make an exception for that. If they lost their jobs, by law, you have to offer a 6-month payment plan. Do that early on and don't wait. After the aging report is the bank statement. So this is the proof that that money is in the bank. But I'm 52, so I grew up having to reconcile a checkbook. If you never did that, there's a difference between what your bank statement says and what the checkbook's balance is, because you might have unclear checks. The balance sheet has the checkbook balance, and the reason why it doesn't match the bank statement is in this reconciliation report. Again, feel free to reach out to the accountants at your management company. They will go through this with you. Finally, if you don't understand any of this, look for the cash disbursements report, which just shows everything that was paid in the prior month. And then at least you can say, yep, we had water, we had CenturyLink. Oh, Colorado door service. Yeah, somebody ran into the garage door, we had to fix it. Oh, the security cert. Oh, it's $1,200 for security a month? Okay, now there's a cost benefit. Could we get it cheaper? Could we bring it in-house? Do we need security? Understanding your financials is power over your financials, and it is the first step in a financially sustainable HOA. So I think that's my last slide. Financial literacy is a foundation for all other sustainability issues. You know, we give these out to the homeowners so they understand, but they're going to be looking to you as volunteer board members, who you want to look to as your management company, your reserve study, and then you should also have a CPA who is watching over everything. I'm going to turn it over now to Bryan Farley, and thank you for your time.
Okay, thanks, Chris. Appreciate that overview of how to read a financial packet at the HOA level. So next up, we have Bryan Farley. He will be discussing the importance of the reserve study and how it can be used as an effective financial planning tool for communities. Bryan, thanks for joining us. He is the president of Association Reserves Colorado, and he is certified by CAI as a reserve specialist and has performed over 1,500 reserve studies in his career. Okay, Bryan, I'm going to pass it off to you in just a moment. Okay, it's all yours. Thanks, Bryan.
Thank you, Chris, and thank you, Chris, as well. Excellent. So I will be talking about pretty briefly. So if you all need to get in touch with me for further details, please do not hesitate. My contact information will be on the last slide for my presentation. I would highly encourage you all to reach out, or if you want to find it out now, you can just go to www.reservestudy.com and you can find my information there. But I'm hoping that you'll pay attention during this so I can kind of briefly give you an overview as far as how can we make living in an HOA financially sustainable. I think what happens for a lot of our clients is they look at it, living in an HOA as torture sometimes. They look at it as, I'm putting all this money away and I'm not seeing a return on my investment. They go, man, I'm putting all this money and I think it's going to the water for the lawn, but why am I paying so much here? Like, I don't get this. And so what a reserve study is really going to help our clients understand is whether or not they're putting enough money away adequately. And there's a lot of transparency there. And so the question that I would like to make sure that everyone understands is, hey, Chris, looks like I don't have access.
Sorry, Brian, try that now.
Okay. There we go. Okay. So the question that we really want to make sure that we understand for our clients is understanding whether or not they are financially healthy or financially stable. So to give you some context, really what we're trying to establish in our profession, in my profession, is making sure that every owner is paying a fair share of the annual deterioration of the property equally. So for example, let's just say you live in a property for 1 year. Well, therefore, you should only be responsible for paying for 1 year's worth of deterioration. If someone's lived at your property for 20 years, well, then they should be responsible for paying 20 years of the deterioration at their property. It's the most fair and equitable way of handling expenses which come from your reserves. And again, we're going to go through what those expenses are. But as I talk about this, please make sure that that is clear in your mind. The entire presentation is the goal of the reserve study is to establish the annual rate of deterioration. What are the annual expenses? Or think of it this way, what's your annual bill of your reserve expenses? Because I bet most of you all, if you were to look at your budget, look at your balance sheet, etc., it's pretty clear to understand where your money's going for your water bill or for your gas bill, or if you have your own personal, internet, it's clear. That's an expected expense. It comes every single month, so you guys pay it on time. If you don't pay it on time, well, guess what? That service gets shut off and you no longer receive access to it. However, your roof or your sidewalk or your painting of your exteriors, they're not coming every month to give you a bill for that expense. And so that's what the reserve study is going to tell you. What is that annual bill for those expenses? So the first thing that you want to do, and the first thing you want to understand is answering that question of whether or not we are financially sustainable or are we financially healthy, is to get a reserve study. A reserve study will clearly explain whether or not your association is financially healthy and financially stable. The reserve study is going to give you 3 key results, and we're going to go through each of these 3 key results in this presentation. You have the component listing, the reserve fund strength, and the funding plan. And so we're going to start off with the building block of the entire reserve study. This is the component listing. So a component listing is based on a visual, site inspection, and research. This is where we essentially capture all of the assets that are located at the property. So let's just say you live at a condo development. That means the component list is going to be made up of your roofing, your siding, potentially a garage, etc., maybe a boiler. If you live in a single family home development, that component list is going to include potentially your streets, maybe some perimeter fencing, or maybe a pool and a clubhouse. So every single property is going to be custom in the reserve study because every single property is different. So there's really no one size fits all. Each reserve study must be custom for your property because it's going to have a custom component list. The component list is going to give us these 4 details. The description, what is the asset or the component that we're looking at? Useful life, how long should this component last? And this is going to be based off of either local conditions or historical averages or vendor recommendations that deal with this kind of component on a daily basis. Next is the remaining useful life. How much longer is left on this specific component until action is required, meaning whether it needs to be painted again or if it needs to be replaced. And then also it tells us our current cost of replacement, not what it's going to cost in the future, but it's current cost today. Even if it's not going to be replaced today, we need to understand what its current cost is. So when you break it out, this is what it's going to look like on a reserve component list. Of course, you've got your scope. So let's look at the roof. We've got a roof replacement project that's about $80,000. So the roof is $80,000. That's the asset, that's the component, and that's the cost. It gives us our scope. Next, we have the schedule. The roof is should last about 20 years, and it has about 18 years remaining. So what it tells us is 2 years ago, this roof was replaced for approximately $80,000 because it's a pretty good cost estimate given that it's so recently replaced. So now take a look at this component list and notice something for me if you don't mind. Notice that every single expense, it doesn't fall on a very predictable timeline. Or not predictable, excuse me, on a very smooth timeline is a better way to say it. So meaning in 18 years, you're most likely going to have a large expense of around $80,000. But in 5 years, you also have another $80,000 expense. And then look next year, you've got a $50,000 expense. And this $50,000 expense occurs every 10 years. So what happens is your reserve expenses are not going to be fair, meaning they're not all going to be spread out evenly and evenly distributed throughout the years. So take a look here. Imagine, let's just say, put yourself in a situation where you moved into a property in 2016, and then you move out in about 2019. So you'll say, you know what? My HOA experience was great. We didn't have that many expenses. Everything was pretty easy. I enjoyed it. It wasn't a bad experience. Now, let's just say you move into a property in 2029, and you've said, okay, I've looked at the past 15 years of data. They've only ever had an expense exceeding $500,000, a couple times, maybe 3 to 4 times. So I don't expect anything greater than $500,000. All of a sudden next year, they have a $2 million expense coming up. So if this association was not budgeting properly and looking ahead and already planning for this expense to occur, well, this guy who just moved in there in 2029 is going to have to foot part of this bill, this $2 million expense bill, which should have been already taken care of and already planned ahead. So as you can see here, if proper contributions are not put away and not planned ahead, certain people are going to have to pay more and certain people are going to have to be in a lot more trouble. And that's an unfair way of running an association. It's unequitable and unfair, and it's not fiscally responsible. So this brings us next to the reserve fund strength. So how do we know whether or not an association is in a dangerous position like this, where they have these large expenses that weren't prepared for? How do we know? And so the reserve fund strength is going to tell us very easily whether or not an association or a property has the financial strength available. So the way that we find this out is something called the percent funded. Percent funded is just kind of a yardstick for us to measure one association versus the other. It gives us a visual impact to understand, is my association doing well, or does my association need work? Again, it's a yardstick. We can compare your percent funded for your property against any other property in the world, regardless of whether it's a single family home or a high rise, or if it's a multi-thousand unit single development city, right? We can tell based on this simple calculation whether or not your property is well funded or if it's poorly funded. And so the way we do that is just understanding, first of all, what is in the reserve fund? So how much money is available or how much money is liquid for your reserve components? Then we establish the total value of deterioration. A simple way to put this is we just understand the depreciated value of the assets. And so we'll sum that up for all of your assets, take that as our denominator, divide these two, and it gives us a percent funded. So percent funded then tells us whether or not an association or a property is at risk for special assessments, deferred maintenance, and cash flow issues. Because once we run that calculation and we establish that a community is at 30% or lower, well, we can see here that when an association is 30% or lower, they can have potentially a almost 60% risk of special assessment, meaning there's over a 1 in 2 chance that a property that's down in this lower end is going to have a special assessment. It's a super high risk. It's not financially sustainable. And that means that the owners are constantly paying these huge expenses to take care of things that should have already been prepared for. However, look over here at the 70% and above, it's green. There's a less than 1% chance risk of special assessment, meaning there's a nominal risk, almost no risk statistically for a property that's well funded. So we want to make sure that our clients are trying to get in this position right here, because this is where we see the success, the financial success for our clients, where there's not these huge expenses occurring randomly. You know, things are predictable, things are planned, things are being taken care of. And so what are some of the consequences of under reserving? What are some of the things that you may see at your property, or things to look out for at your property? Number one is deferred maintenance. And so what happens if maintenance is deferred? It's only going to get more and more expensive. So for this example, a painting of a building typically costs anywhere from $1 to $1.50 potentially to paint a building, $1 to $1.50 per square foot. That's the cost to paint a building. Now, to do a replacement, specifically an emergency replacement, because things were potentially not taken care of, could be almost $20 a square foot. So if a client is painting their assets on an ongoing basis, meaning every maybe 3 to 5 years or 5 to 7 years, depending on the product, they have a vendor come out and they're constantly painting and checking in on the siding, they're going to catch any sort of potential issues that may occur, like a water intrusion or a leaking gutter that's coming into the building. They're going to be able to check that because they're maintaining it on a very regular basis. They're planning for it, they're painting it, etc. However, let's just say a client defers maintenance for maybe 10 years rather than painting it on time, just to save a bit of money because they want to put money elsewhere. Well, now, unfortunately, they've got this $20 per square foot, so 20x the normal amount just to do an emergency replacement. So deferred maintenance, even though it may seem like you're saving money now, you're actually just pushing those costs and multiplying them out the longer that they're deferred. Another issue that we see is lower property values. So what we did is we took a sample size of about 20,000 properties, and then we ran those against basically some home sale sites like a Zillow. And those 20,000 properties were in our database. And so we essentially said, okay, run the percent funded versus the home sale value. And what we found is that a well-funded association increases the home resale value by about 12%. So what does that mean for you all? I don't think what's going on is a client or a potential buyer is a better way to put it. A potential buyer is going to go into a property and say, hey, can I see your reserve study? Because I want to pay you more if you're well-funded. That's not the way it works. But what's happening is a well-funded association is going to have great curb appeal. When you drive in to buy a property, everything's going to be well-maintained. The siding's going to look nice and clean. The roof is not falling apart. There's no potholes as soon as you drive into the property that damage your tires as you're trying to get in. Everything is taken care of and it looks nice. And also there's that peace of mind too. When you buy in, you talk to some of the potential neighbors that you may live with and say, hey, how do you like living here? They're not going to say, well, I think there's going to be a special assessment next year. I don't know. I hate the board. I think they're stealing money. There's that kind of confidence and that you're buying into a property that's well maintained, well organized, and that has your best interests in mind. Another issue that we see too is, well, if you saw that last slide and you said, well, yeah, okay, reserve contributions may help us have a high resale value, but no one's going to want to buy my property because our contributions will be too high, our dues will be too high, so no one's going to want to buy into my property. Well, here's the thing, your reserve contributions, adequate reserve contributions will actually cost your ownership less than the other options out there. So let's just say right here, this example, we have a 15-year roof that costs $250,000. So a 15-year roof that costs $250,000. And then your bank, where you're putting your reserve account balance, is getting about 1% interest on it, okay? So even with those nominal amounts, 1% interest on your bank account returns, you're still gonna only end up paying about $231,000 for that roof. So it's a savings of $20,000 for your ownership. You've saved them money just by doing adequate reserve contributions. Your other option is special assessing. So now you've charged your owners $20,000 more for the same exact product. Another option, of course, is getting a loan. So let's just say you don't want to have to special assess. Potentially you've got owners that are on a fixed income and they can't figure out a way to have that money available at the right time. So you have to get a loan to get that project done. Well, that's now a $90,000 cost increaser. So you've now charged your ownership $90,000 more for the exact same product just because monies were not set aside at the right time and planned ahead for. So what to do next? So maybe you're thinking, okay, I think we're okay. Like, I think we've got $1 million in our reserve account. I hope that's enough money for our upcoming expenses, but I'm not really sure. I think we're okay. You know, what do you do next? And so I would say the most important part of our reserve study, when you get a reserve study to double check all this, is the funding plan. This is essentially where the rubber meets the road. Because, you know, a good quote that I like to reference for my clients is Warren Buffett. He has a quote that says, what's important for your investing is not timing the market, meaning timing when the market's going to drop or increase. What's most important is time in the market, meaning how often you put your money into the market and then the time that it grows. It's the same thing with your reserve account balance. You may say, okay, well, we don't need the money until 15 years when that roof's due, so we're just going to wait until then. Because by that time, it's going to be too late, right? So you need to make sure that you're putting adequate reserve contributions and funding those assets as they deteriorate on a monthly or quarterly or however you all do it basis, making sure that the proper funds are put away ongoing, not skipping years, not delaying years, not deferring those expenses, but putting away money ongoing, right? This is predictable. This is inevitable. These are things that we know will occur. There's no excuses for not putting the right money away now. And so on our reserve study specifically, when you get a reserve study, try to look here for this deterioration cost per year. I'm not sure if you can see this, but this says the deterioration cost per year. So this is going to tell you what the asset or the component, what its cost is in deterioration on an annual basis. So for this example right here, you can kind of see this client, their rate or their cost of deterioration is about $37,000. So that means if the client is just to put in $37,000, they're not going to get ahead, but they're not going to really fall behind. They're just kind of keeping pace with the deterioration. But also remember, next year, they're going to have inflation acting on all their components. So that number is going to have to increase. So they're going to have to constantly be playing catch up essentially. So the funding plan is going to help you understand not only how to keep pace, but to also get ahead and making sure that you have proper funds put aside to plan ahead. And so another question that we do get though, in regards to that, when people see that there's this bill, this annual rate of deterioration bill that they have to pay, they say, well, look, our ownership can't pay for that. You know, we have owners that are on a fixed income, or, I mean, this is a great example right now. We have some super tough times right now. People may not be able to meet payments. And I totally get that. Those are all valid arguments. And so I want to reframe that question for you, is to say, let's see what's important. You may have seen this brand before, this mermaid brand. I'm not sure if you've ever seen them before. Maybe you have, but it's a local company, I think, right, guys? It's called Starbucks. But a cost of coffee from this brand is about $3 to $5 a day, depending on the kind of drink you get, like whether it's like a special latte or something. So it's about $4, $5 for one of their lattes. Now, a lot of people I know buy a cup of coffee a day. No problem with that at all. It's basically a special treat essentially that people kind of indulge in. Nothing wrong with that. But what if I told you that just to maintain your association, it's the exact same cost? So it's about, what we find is it's about $3 to $5 a day per unit to successfully maintain your reserve expenses at your property. Understand that those numbers could change. Let's just say you live in a huge development with thousands of homes and all you guys own is a monument sign. Well, that number is going to be a whole lot less. Or let's just say you live in a a really special penthouse high-rise unit that only has 4 units. Well, that could be a lot more, right? Because you got less ways to distribute that cash. But on average, for the majority of our clients, the cost of maintaining your reserve components at your property is about $3 to $5 a day. So my suggestion to you all, when someone says we can't afford that, you say, look, I think we all can afford about $3 to $5 a day to maintain most likely our biggest purchase that we've made. It's worth it. It's worth it. And it's actually fairly cheap relative to lower property values. It's cheap relative to deferred maintenance. It's cheap relative to special assessments and loans. So it's actually the most affordable option, and it's doable. It's plausible. People can do this. People can put away $3 to $5 a day for their home. So what do you all do next? Now that I've kind of given you all this data, what do you do next? So my suggestion would be, if you have a reserve study, update it. A reserve study is only as good for the fiscal year in which it was created for. Let me repeat that. It's really only good for the year it was created for, because all of the assumptions made on your reserve study are just for the year it was created for. So if you have a reserve study that's 3 years old, that data is now all outdated and no longer useful. So update it. Or if you don't have a reserve study, get one commissioned. How do you know whether or not you're putting away proper funds? How do you know you're not overcharging your ownership? You have to have the data to make a wise financial choice. The reserve study is going to give you things we talked about: the component listing, understanding what's the description of the component, what's the useful life of the component, what's the remaining life of the component, and what's the cost. And it's going to tell you also your percent funded. Are you at a high risk for special assessment? This client's at 15% funded, and guess what? They have a special assessment coming up. They're at a high risk, and they actually have the risk coming to fruition. And it's also going to tell you the recommended funding plan. What is the funding amount this client needs to avoid further issues and to maintain and upkeep their property? So as I close up here, what is in summary, what's kind of the succinctly put overview of this presentation? Number one is you have to get a reserve study completed. If you do not have one completed, you have no idea whether or not proper monies are going away. There's no transparency as far as where monies are going, because you don't really know what you're paying for. The goal of the reserve study is to offset ongoing deterioration. The reserve study is not a cash flow projection. It's not telling you, hey, in 25 years, we will need $25,000. No, the goal is to annually keep pace with that deterioration, which is predictable, so that every single owner pays their fair share, regardless of when they move in or move out, right? Everyone's paying their fair share. Ultimately, boards are responsible. They need to take the initiative to take care of their association's components as they deteriorate. And so they have to make the choice, and they are essentially responsible for the fiduciary success of the association. Reserve expenses are inevitable and predictable. We know these assets will fail. A roof does not just fail overnight, rather steadily over 15 to 20 to 30 years, however long your roof should last. Every single night, every single day, it's deteriorating predictably. Next, reserve expenses only get more expensive when they're deferred. So just because you put your head in the sand and say, we're trying to save money, so we're not going to maintain things, understand that this is going to cost your ownership more money down the line. And then lastly, owners are going to pay the cost for their reserve expenses one way or the other. We would say the cheapest way to do it is predictable and equitable reserve contributions. That is the cheapest, best way to do it. But if not, they're either going to pay for it in deferred maintenance expenses, they're going to pay for it in lower property values, or they're going to pay for it in loans or special assessments. So we would recommend the most affordable option being reserve contributions. And so that's the end of my presentation. If you want to talk to me further, here's my contact information right here. You can email me or call me, whatever you prefer, or go to our website at reservestudy.com, and we have a wealth of other information, reports, etc. on there for you. So thank you all so much.
Great, thank you, Brian. The reserve study, a tremendously important tool for financial planning for associations. We have just a few minutes left, so I'm going to check to see if we have any questions. A couple of quick ones. This is a question for Brian. If a component needs to be replaced, but it is still working, should we go ahead and replace it?
Right, so this is a good question. Thank you to whoever asked that. It all depends. Let's just say we've got a elevator system, which the reserve study says should be replaced. Then yes, because this is a life safety system. And what happens is if you don't plan ahead for an elevator replacement, now you've got to do a replacement potentially on an emergency basis. And you're gonna have to call the vendor, and it might take 6 weeks for them to get out. And they might have to shut down the entire building until it can be fixed. Or what if you have a boiler, another good example, that needs to be replaced on the reserve study and you all push it out? What if on New Year's Eve or Christmas Eve, the boiler goes out and the pipes freeze because the boiler wasn't working? These are life safety issues. But what if you've got a couch in your clubhouse that looks old and the reserve study says it's time to replace it, it's outdated aesthetically? That's one of those things where the board can make the wise choice and say, you know what, this is not the utmost importance right now. We're going to defer this and plan to use those monies potentially next year. So when looking at your reserve study, understand that it's a guideline. It's a guideline and a tool for the board to make wise financial choices. It does not mean you're not legislated or anything. You don't have to follow the reserve study perfectly, but understand that there are certain components which are more important than others.
Great. One other question for Bryan. What would you recommend to an HOA whose reserve study is at an at-risk % funded, but by the bylaws and the governing documents for the association, they can't raise their dues more than 5% per year?
Right. I mean, that's very common. And so basically there's, what he's saying is their declarations or the bylaws are saying we can only peg our increases by X% per year. That's horrible, because you're basically hand tying the ownership and the board to have to suffer because the bylaws state that. So my recommendation is, number one, I would seek to amend that, because that's an unfair way that's essentially good intentions gone bad. They're trying to control the sort of increases that a board can implement. But the problem is you need to put that money away. It's the board's fiduciary responsibility to put in predictable and invariable expense reserve contributions to cover those expenses. And so that would be my recommendation. Number one is you would unfortunately have to get those amended. But I would say even just common sense, that's not the proper way to run it right now. The board needs to take care of their fiduciary responsibility, even if that means essentially not following those bylaws. But I think step number one is talking to an attorney first, to make sure that can be amended, because that's an unfair way to run the association.
Great. Chris, we got a couple questions kind of just in general about HOA financials. The first question is, I'm on our HOA board, but I'm not an accountant or a CPA. Are the financials typically done on an accrual or a cash basis?
Under Colorado law, they're done under an accrual basis. Where that gets confusing is, when do the expenses hit the income statement? And we have a cutoff date. If the invoice comes in by the 25th, we'll post it, because we promise you as an HOA your financials by the 6th business day. So there's a lag time in reconciliation. It's easier to understand cash, but I go back to the cash disbursements report. Familiarize yourself with what's being paid on a monthly basis, and then look at the income statement to see your variances. Are you over or under budget on specific items? And tie that back to the balance sheet. And one thing you want to look for on the balance sheet is the money actually going from the operating account to the reserve account. That is a big red flag.
Great. And then Chris, last question. Someone wrote in, I'm a new board member, but I'm just learning the basics of HOA financials, but I'm worried that our previous board hasn't been very good managers for our community. Would you or you guys be willing to sit down with our board and look at our reserve study against our financials?
I think both Bryan and I would love to sit down with you. And when I talk about Chris Marion as our Chief Sustainability Officer, if you're financially stable, your reserve study is funded, you're planning for these projects as they're coming up, then you can look at other ways to save money. Water conservation, renegotiating your trash bill. I guarantee you 90% of HOAs haven't negotiated their trash bill in 5 or 10 years. you could save half of your expenses there just by renegotiating it. So Brian and I and Chris would love to sit down with you either as a group or individually.
Great, thanks, Chris. Well, perfect segue into our next topics. We are going to be presenting specifically on environmental sustainability for HOAs a week from today. So that's next Wednesday, May 13th at 11. You'll also receive a unique link for that. And then followed by community sustainability for HOAs, how to encourage meaningful engagement and participation in your neighborhood. That's going to be the following Wednesday, May 20th at the same time. So I'd like to just thank everyone for joining today. You should have all of our contact information. Feel free to follow up with any additional questions or feedback on today's webinar. Thanks again, and we hope to see you next week and the week after that. Take care. Bye-bye.
Thanks, everyone.